Good afternoon, and thank you for attending today's webinar on the economic impact of COVID-19. My name is Mike Seaman, and I'm a senior graduate admissions counselor at Canisius College. Before we start today's presentation, I wanted to let you know that our panelists will be taking questions throughout this virtual discussion. To submit your questions, please use the Q&A section, and you will be responded to by a panelist throughout today's presentation. At the conclusion of today's presentation, we will open up a Zoom meeting room where you'll be able to ask our presenters additional questions face-to-face. This is optional, you do not need to attend, but if you wanted to have more information and speak directly with our presenters, you'll be able to do that as well. The link to enter that meeting will be posted in the chat section towards the conclusion of today's virtual discussion. Now I'd like to turn it over to Dr. Denise Rotundo, the Dean of the Wehle School of Business.
Thank you, Mike. Hello, everyone, and thank you for joining us today for a very special presentation on the impact of COVID-19 on the economy. As Mike said, I'm Denise Rotundo, and I'm really proud to be the Dean of the Wehle School of Business at Canisius College. You know, faculty are without a doubt the greatest asset of any college and university, but what makes the three faculty leading the conversation today so uniquely qualified to do so is that they all hold PhDs in economics, and they're all practicing economists as well. And that combination of academic and professional experience is a rarity in higher education. And it's also why Canisius has such a long tradition of graduating so many top business leaders across our region and beyond. So today you're going to hear from Dr. Juliana Golubieski, Assistant Professor of Economics, Dr. George Palumbo, Professor of Economics and Director of the Graduate Business Programs for the Wehle School of Business. And leading us off today is Dr. Mark Saporowski, Professor of Economics and Chair of the Department of Economics and Finance at Canisius. So without further ado, I'm pleased to turn it over to Mark Saporowski. Mark?
Thank you, Denise. What we're going to do is to look at the impact of this pandemic on the macro economy, on the state economy, and on the local economy. I'm going to handle the macro economic part of things, and my colleagues will handle the state and the local impact. What you see on your screen right now are, let's say, real GDP growth rates since 2007. We've included, let's say, going back to 2007, because we like to take a look at, let's say, where has the economy been before we start talking about where it's going. If you look at the last bar to the far right, you'll see that real GDP growth during the first quarter of 2020, which are the advanced estimates, the GDP numbers come out initially, and then they're revised twice. It shows the economy declining by 4.8% in real terms. So, you know, really, this whole episode, we're unquestionably in recession right now. And, you know, what we'd really like to take a look at is, you know, do we have any clue as to how long the recession will last, how deep it will be? We hope to shed some light on those two questions. I'd like to start by looking at the last recession that we're in, which was the 2008-2009 recession. That recession began in the first quarter of 2008 and ran through the second quarter of 2009. It was driven by the housing bubble, which burst, and the financial market meltdown which ensued. And that recession was the worst recession that we've had in the United States since the Great Depression of the 1930s. It's been dubbed, let's say, the Great Recession, and it lasted 6 quarters. Should mention that, let's say, the average post-World War II recession lasts about 10 months if we look at all the recessions since the end of World War II. The recovery that began during the third quarter of 2009 really lasted until the last the fourth quarter of last year. And the duration of that expansion was 42 quarters. It's much longer than the average post-World War II expansions, which have been roughly 15 quarters on average. The present recession really has been driven, if you look at the minus 4.8% growth, or the decline in real GDP, it's been driven by a 7.6% decline in personal consumption expenditures and a 5.6% reduction in gross private domestic investment. It's important to recognize that generally, as consumers go, so goes the macro economy. And so personal consumption expenditures make up roughly 70% of gross domestic product. This lockdown that we've had obviously is going to be severe, let's say, during the second quarter of the current year. I should also mention that, let's say today, the Bureau of Labor Statistics published the April Consumer Price Index. And there was a decline in the index. And what I like to do is to take a look at, let's say, from April of 2019 to April of 2020, what's the inflation rate been? And, today's numbers show a less than 1% inflation rate. If you do the calculations, it turns out to be 0.33% inflation over the past 12 months. Obviously, that's been affected by oil prices, and which have been at record lows, among other things. The CPI had been increasing at roughly 2% per year prior to the April numbers, which have come out. It's typical for the rate of inflation to drop and sometimes go negative, so we have deflation during economic downturns. Okay, so what we would like to do really is to, let's say, explore possible answers to the following questions. What will the magnitude of the decline in real GDP be? And, what will be the duration of the recession? How long will it last? And really, we feel that, answers to those questions are really highly dependent upon how consumers will respond once things are loosened up, as they're starting to get loosened up a little bit now, state by state, reopening. So we want to take a look at the labor market, in particular, payroll employment. And this slide that you're seeing now shows monthly changes in U.S. payroll employment over the period 2007 to 2011. And again, the reason we're showing this is to kind of compare, let's say, this last recession compared to what we've experienced right now. And you see that the payroll employment numbers during the recession were declining. And over the basically 24-month period, the U.S. economy lost about 8.7 million jobs during the 2008-2009 recession. Actually, the payroll numbers peaked in January of 2008 and didn't recover their pre-recession levels during that past recession until May 2014, which is more than a 5-year period. So, once recessions hit, it takes some time to regain those jobs that we lose as a result of recession. The next slide that we see is the payroll employment numbers 2016 to 2020. And again, you can barely see, these monthly numbers are very, very small. Those bars that you see, you can barely see them. But then all of a sudden, we have the economy tanking virtually overnight. And in just 2 months, we have lost more than 21 million jobs in March and April of 2020. And, this is really unprecedented in terms of, let's say, a 1 or 2 month loss in the number of jobs that the economy is given up. And, if we compare these 2 months with the more than 21 million jobs lost, that's more than 2 times greater than the job losses that occurred during the Great Recession of 2008, 2009, which occurred over a 24-month period. So here we've got 2 months compared to 24 months, a dramatic difference in what we're experiencing at present. Should mention that the April unemployment rate was 14.7%. And it's important to recognize that when the Bureau of Labor Statistics garners the information to determine what the unemployment rate is, they collect, this is the household survey, and the household survey is collected in mid-April. So it's likely that, let's say, for the entire month of April, the unemployment rate is going to be considerably higher than the 14.7%, which was recently published by the Bureau of Labor Statistics. What we see on this slide would be weekly claims for unemployment insurance benefits over the period 2019 to 2020. And again, you see the spikes that occur. We've had almost 33.5 million new unemployment insurance claims over the 7-week period ending May 2nd, 2020. So this data suggests, this will filter into unemployment rate in May, which is likely to be in the 25% range. And again, we haven't experienced that level of unemployment since the Great Depression of the 1930s. So, how severe will the decline in real GDP be? I mean, all these things the labor market points to a fairly substantial decline in GDP. And if we look at, what some of the economists at financial institutions and at research institutions are suggesting, we could see a 30 to 40% decline in real gross domestic product during the second quarter of 2020. We don't think, that's going to be a dramatic decline during the second quarter, but the magnitude will not last during the last 2 quarters of 2020. We don't believe that they will last. The historic nature of the data that we're seeing right now in the macro economy has been pointed out by Federal Reserve Chairman Jerome Powell, saying, we're going to see economic data for the second quarter that's worse than any data we have seen for the economy in recent times. What we'd like to do next is talk about, well, how has the government, the federal government, and how has the Federal Reserve responded to the disaster we're currently facing? And the first thing, we start out looking at fiscal stimulus, which has been allocated by Congress, has been in the range of about $3 trillion. The most important part, this was the $2.2 trillion CARES Act. And you see on the left-hand side, which is the helicopter drop of money. And this is a term economists have used. In fact, Milton Friedman coined this term as, putting money directly into the pockets of consumers. And that's, I guess those payments were $1,200 if you meet certain income criteria. Additionally, unemployment benefits have been increased. There have been small business loans that have been made available. There have been subsidies to certain industries. and there has been aid that's been allocated to state and local governments as well. The Federal Reserve, I think, recognized the economic problem pretty early on, and they lowered their federal funds rate target to 0% to 0.25% during 2 emergency meetings in March, on March 3rd and March 10th. They've expanded their balance sheet dramatically by $3 trillion. And, you know, the idea here is to provide liquidity to the financial markets to stabilize the financial markets. So, you know, among the things that the Fed has done, first, they've, you know, monetized the federal debt by purchasing the lots of U.S. Treasury securities. They've reinstated TALF. TALF is the Term Asset-Backed Securities Loan Facility, again, to provide liquidity to markets. They have purchased corporate debt, even non-investment grade debt, which has been, you know, a relatively new phenomena. And they've also purchased state and municipal debt. Now we'll turn it over to my colleague, George Palumbo, who will talk about the state and local economy.
I'd like to start with the Federal Reserve actions and what it means, why it came about, and what we can expect from the Fed, and how the relationship works between the Treasury activity, U.S. Treasury activity, which is borrowing money to finance the deficits that Mark referred to, and the Federal Reserve. So let's start with that massive fiscal stimulus, the $3 trillion of new money in what's called emergency fiscal activity. We should remember that $3 trillion is added to what was budgeted already to be about a $1.2 trillion deficit, so that the U.S. government was borrowing $1.2 trillion and now adding $3 trillion. You should also remember that the Treasury is always refinancing its existing parts of its existing $20 trillion debt. So there was a lot of new borrowing going on by the U.S. Treasury. For that to happen, you have to put more money into Treasury bonds, and that usually occurs by increasing the yields on those bonds. Now, there are 2 kinds of bond market activities out there. There's the issuing of new debt, which is what we're talking about right now, and the new debt, to attract more money, would generally have to have higher coupon rates. Now, then there is, at the Treasury level, over $20 trillion of existing debt with fixed coupon rates. And the way that reacts to the higher coupon rates of new issues is the price of those existing bonds falls, so that you get equal yields whether you buy new issue or existing issues. So that extraordinary amount of new borrowing announced basically in March of 2020 led people who manage money to say something is going to happen. Now, I'm going to talk about the other sectors of the economy, but before I do, let's talk a little bit about how Treasury rates affect borrowing rates in other markets. There is a spread, generally speaking, between Treasury rates and state and local bond rates. That spread has historically, well, it varies, it fluctuates. It's affected by the perception of the relative risk between state and local bonds and Treasury bonds. They will earn, the people who lend money to state and local governments will earn a risk premium. At one time, that risk premium was quite low. And once you adjusted for the tax benefits of tax-exempt bonds, reducing the liability of federal income tax liability on the interest earned in state and local debt, state and local yields were traditionally, historically lower than corporate yields, but than treasury yields. But that is no longer the case and has not been the case for many years. So there is a risk premium for state and local bonds over the treasuries. There is a risk premium that is even higher for corporate bonds over treasuries. So what we see is three markets: a treasury market, a state and local government market, and a private market. The biggest part of the private market is corporates, but not the only part. Okay, so what was happening in mid-March? We saw money managers starting to think that treasury rates were going to go up, yields were going to go up. That meant state and local yields had to go up. All the existing debt, some $3 trillion worth of existing state and local debt with fixed coupon rates, had to fall in price to earn equal yields. Money managers, portfolio fund managers, pension fund managers, people managing grandma's money, they all looked at what they saw the future to be and said, it's time to sell before treasury rates go up. The spread on treasury to state and local securities increased to about 200 basis points, which means two full interest rate points above the 10-year. So AAA, top quality state and local debt, was now selling with a risk premium, with a spread of over 2% to the treasuries. That is quite a bit higher than it had been before. Corporate, AAA corporates, had the spread between them and the 10-year treasuries grow to about 3 times, slightly over 3 times the 10-year treasury yield. And that occurred very rapidly in mid-March. Around the 21st of March, it was growing and setting off a secondary round of almost panic selling. That is when the Fed stepped in and said, we are going to supply liquidity to these markets. We are willing to buy state bonds, municipal bonds, local bonds, corporate bonds, not just the AAA rated bonds, but as Mark pointed out, junk bonds. And they were going to step in and buy asset-backed securities. Asset-backed securities are securities whose interest payments and principal repayments are generated by some kind of asset like home mortgages or commercial mortgages or revenues from other enterprises. Those are the things that we saw most dramatically affected in the 2009 market meltdown. So the Fed stepped in because of the massive increase in fiscal activity. It was important. They did shore up yields. The price of state and local bonds, for example, stabilized, and they did reduce the spreads. About in half now from where they were at their peak on March 21st. But there is an increased perception of risk. And I'm going to go through on the next 3 slides the causes of increased risk at the state and local sector, some of the causes of increased risk at the corporate sector, and what we see is the causes of increased risk at the asset-backed sector. So let's start with New York State. because that's where I am right now. And I wanted to keep things simple. New York State, like most states, depends on two classes of taxes to generate revenue. Individual and corporate income taxes, and sales and gross receipts taxes. Well, clearly, the individual income tax is income-based. The sales and gross receipts taxes are a function of consumption, which we know is income-based. For New York State, about 93% of its tax revenues come from those two sources, which are income-based. So income taxes and sales and receipts taxes. How far different is New York State from the national average? The national average is about 87% of total taxes collected. Now, we know the unemployment rate, the shutdown has dramatically reduced people's incomes and has affected the tax collecting capacity of the states. Now, there are some other states that don't have income taxes that have things like severance taxes, extractive industry taxes. Every barrel of oil, about 19% of their total taxes. New York State government receives aid from the federal government to offset many social services programs in which we participate. That aid comes to about 76% of all the tax revenue that the state collects. At the local level, total aid is 66% of taxes, but most of that aid comes from the state government. 58% of total taxes comes from New York State governments. All right, one last step here then. State government's tax revenues are going down, local government's sales tax revenues are going down, and the prospect for aid from the state is going down. Those are the things that are making local government bonds less creditworthy at the moment, more risky. So would be generating higher yields. The Federal Reserve has stepped in to buy state debt and to buy municipal debt to stabilize those markets. Okay, so what else is going on in the world? Well, none of the three of us, Dr. Rotundo suggested all three of us have PhDs in economics. All three of us have spent most of our adult lives doing economic analysis, and none of us would have predicted the possibility of a negative price in anything. But sometime in the middle of March, we saw oil futures close at minus $36 a barrel. That gives you some idea of the extent of the change in the demand for energy products, and specifically those based on oil. While that was going on, the market capitalization of Netflix exceeded that of Exxon Mobil, a standard name of a giant oil company. Does Exxon Mobil have a problem? Yes, at the moment it has a liquidity problem. It is not, its demand for its energy products has dropped dramatically and its revenues have dropped. Does it have an existential problem? Probably not. But those of us in Western New York understand that natural gas prices and oil prices are linked, and that the dramatic decline in oil prices has hurt the higher cost extractive industries like natural gas and oil from the Marcellus Shale, much of which is in Western Pennsylvania. What about retailing, other kinds of corporate activity? One of the biggest brand names in the country is Neiman Marcus, and it is filed for bankruptcy. So the extra risk in the corporate sector is sometimes a function of liquidity and sometimes a function of solvency. Retail industries were in trouble before this. Finally, what about the asset-backed securities and the property tax? We believe that housing values will fall. We don't know how much they will fall. We don't know for how long they will fall. A lot of it depends on how quickly we recover from this. Nobody on this panel knows what's going to happen as the country reopens. We do know that incomes fall during recessions. We know we're in a recession. We know that people are going to have problems with their mortgage payments. There may be some defaults. We have some sense that, and housing values, that housing areas, that rents will decrease. All of those things will affect the asset-backed securities. They can, in the long run, depending on how long this effect lasts, affect property tax collections. I would predict that collections rates across the country will decline. The percent of the total levy will go down this year simply because people don't have the money they had. They're using up their savings to live. Now, commercial property values will also change. Some businesses won't survive. I know all of you can think of one or two that you think will not reopen after this. On top of that, the changing in the structure of how we do business. We're shopping from home. The retail industry was under a lot of pressure from online shopping before this. That has only increased. We all know there's 4 of us sitting here right now that are working from home, and probably most of you are working from home. How many of the people who are working from home today will still be working from home when we return to a more regular or normal kind of economic activity? If that happens, we expect commercial property values to go down. So we see stress on the retail sector, we see stress in small businesses, and we see stress in commercial office space sectors. What else do we see? I think we all agree that we're going to find more people getting jobs, working out the problems. Are banks going to take over those struggling oil companies? They don't have any expertise in that. Are they going to take over failing malls? Are they going to take over failing other commercial real estate property? In 2008 and 2009, they faced some of those problems. These are going to be similar but different. And now Dr. Obieski will talk specifically about Western New York, where we are and how we got there.
Okay, so for the local economy, let's first talk about where we've been. Over the past 10 years, we gained about 30,000 jobs in the private sector. That translates to growth just under 6%. Now, the pie graph on the right shows the distribution of that job growth across industries. Now, right away, you'll notice that about 2/3 of that job growth was concentrated in 3 industries: leisure and hospitality, healthcare and social assistance, and financial activities. Now, we expect growth in leisure and hospitality as a result of increases in discretionary consumer spending. So when consumers feel good about their economic prospects, they tend to spend more money, and that contributed undoubtedly to the growth in leisure and hospitality in this area, though the average annual wage for that industry is about $25,000, much less than the median wage of $48,000. Now, we can also look at healthcare and social assistance. Part of that growth was driven by the expansion of the medical corridor. But the other part was driven by growth in the sub-industry, social assistance. The wage in social assistance looks much like the wage in leisure and hospitality. So that sort of shrunk the wage growth potential in the industry as a whole, which leads us to an average annual wage in healthcare and social assistance of about $47,000, still under the median for the area. Now, the last area, which is sort of a bright spot in terms of allowing for some wage growth in addition to the job growth, is financial activities. Now, financial activities growth came from the recognition of the concentration of knowledge and skills in this area. That, coupled with the lower cost of living and therefore the lower wage profiles, really attracted banks and other financial institutions to locate some of their employment here in Buffalo. Now, the growth in these areas leads us to what we see in this graph. So this is the industry composition of employment in 2019. We're comparing the US in yellow to New York State in blue to the green area of the Buffalo MSA. Now, we're going to look at a few of these industries where Buffalo has a higher share than New York State. Now, the first and most obvious is in manufacturing. We are distinctive in that we have twice the share of jobs than New York State has in manufacturing. But other places we might take note of are in retail, trade, and accommodation and food service. In both of those industries, we have a higher share than New York State. The growth in leisure and hospitality contributed to that share in accommodation and food service as a sub-industry. And then lastly, on this slide, I want to point out finance and insurance. So even though we have slightly lower of a share in finance and insurance than does the state, we're now approaching the level of the state, which is of course noteworthy given New York City's historical dominance in that area. So those are some of the areas that I want to take note of in order to inform this slide. So what I've done here, I took initial unemployment claims. Now this is through May 2nd, the latest available information. Initial unemployment claims as a share of 2019 New York State industry payroll employment. Now we're doing the analysis here at the state level because the breakdown of industry in these claims is only done at the state level. And we're not going to be able to get any further local employment information until the BLS releases it on June 3rd. So this is the latest available information. You will notice right away that the hardest hit industry is accommodation and food services. Now, this is not likely to be a surprise given the nature of the downturn and the pandemic and the subsequent lockdown that occurred. We will also notice that there's a relatively high share in manufacturing, in healthcare and social assistance, and in retail trade. Now, because accommodation and food service and retail trade really rely on consumer confidence and consumer spending to bolster their growth, those areas are highly uncertain. When we talk about the reopening of the economy and gaining jobs back, those are probably among the most uncertain. We also notice that in those two industries, Buffalo has a higher share than the New York State average. So when we go to see the area-specific effective unemployment rate, the Buffalo MSA appears to have been hit the hardest. So these numbers represent the initial jobless claims as the share of the February labor force before we experienced the lockdown. So in the Buffalo MSA, about 22% of the labor force submitted a jobless claim. Rochester, it had a percentage that was much lower. Syracuse and New York State also lower. Even US had a lower share than the Buffalo MSA. Now, Mark mentioned earlier that the unemployment rate at the US level was 14.7%. So this number is sort of jarring compared to what is the official unemployment rate. But there are a couple of explanations for that. He hinted at one of them. We have 2 additional weeks of information regarding unemployment claims captured in this number. We also need to recognize that the way we measure the unemployment rate is we capture individuals who don't have a job but are actively looking for work. So when a temporary layoff occurs, the individual answering the survey may say, I'm not looking for a job right now. I'm expecting to go back to the job I had before this had happened. So that is another reason that the official unemployment rate may have underestimated the economic hit in that way. Now, the Buffalo MSA has a higher rate not only because of the industry concentration, but also this, the occupation concentration. So you'll notice here, these are the occupations with the highest New York State job loss rates to date. Top of the list, food preparation and serving, office and administrative support, and sales and related occupations. Now, in each one of these occupations, Buffalo has a higher share of occupations than does New York State. So that is going to explain some of the differential we saw on that last slide. We'll also notice that of the occupations that were hit the hardest by the current environment, they are relatively, they require lower levels of education. We're going to see the opposite true here. Now, the occupations with the lowest New York State job loss rates are in business and financial operations, protective services, architecture and engineering, community and social service, legal. You get the idea. Higher rates of human capital are required for these types of jobs, which is partially why they were able to be kept on, as these jobs are more likely to be able to happen from home. So that is one of the reasons that Buffalo appears to be hit harder, and we will now move on to looking at the unemployment rate by educational attainment.
It's always dangerous to predict the future. I have told anybody who's asked me over the last 20 years about predicting the future, I'd be happy if we can get if I could predict the present accurately. I'm going to go out on a limb here a little bit. Historically, we have seen that unemployment rates are different by the level of educational attainment members of the labor force. It is true again in this recession. The April numbers show that people with less than a high school diploma had the highest unemployment rate. You see 21.2, high school graduates 17.3, some college or associate's degree 15%, bachelor's degree or higher 8.4%, and again, historically, graduate degree holders, people with advanced degrees beyond the graduate of the bachelor's level, have even lower unemployment rates. Not only that, it has historically been the case that the incidence of unemployment is lower for the number of times they're unemployed, and the duration of each unemployment experience is less. So we see, in conjunction with the occupational work that Dr. Golubieski just showed you, that educational attainment has always been, and looks apparently is still, a buffer. Not a guarantee, but a buffer in periods of economic decline. Looking forward, what might we expect to see? Again, it's hard to have any degree of certainty here, but following 2001 recession and 9/11, a lot of economic activity left New York City. New York City has been the epicenter of this disaster as well. I would believe that we're going to see more deconcentration of economic activity in New York City. Much of the growth in finance in the Buffalo metropolitan area occurred following 2001. What else have we seen? Following the 2008 and 9 recession, we saw even more deconcentration from New York City. And again, Buffalo was the beneficiary of that. Do I predict that this time? I believe that a lot of the new jobs that we see that will be starting soon will involve the expertise that we have in the area in finance and insurance. There will be bankruptcies, there will be workouts, there will be banks taking over assets. So I see that coming as well. But I also know that it's dangerous to speak with any certainty. I'd like to thank everybody who attended, our participants. I believe there are still 93 out there, and we are happy to take questions.
So we did have a couple questions that were submitted ahead of time that I'd like to run by the three of you. The first one is, what do you see as this prospect for business growth between the US, especially in the Buffalo area, and Canada after the stay-at-home order is lifted?
Well, George just touched upon it, but I think that the work from home model will continue. So where businesses had previously been afraid to allow their workers to work from home, productivity estimates really didn't go down that dramatically. As we were all sort of forced to work from home, productivity only declined 2.5%. So now I think businesses are more likely to allow that work from home, and that's going to benefit areas like Buffalo with relatively low costs of living and therefore lower wage profiles. That we can work from here regardless of where that firm is headquartered.
The next question that was submitted is, in what areas of the Western New York economy would you expect to see growth in the months ahead?
As I said when I was talking about educational attainment and unemployment, I believe we're going to see more in finance, as Juliana just pointed out. Not only do you not have to pay New York City rents if you're going to be working from home, you don't even have to pay Buffalo rents. I think we'll see that. I'm comfortable predicting that we won't see much in the way of leisure and hospitality and dining. I think manufacturing will be affected. I think low gasoline prices, to distill it to the, pardon the pun, to its lowest level, will lead people to increase their consumption and change their preferences to, again, back towards conventional internal combustion engines, and Buffalo manufacturing reflects in large part what's going on in the auto industry. So manufacturing, I think, is good. Healthcare, and I think finance. Mark?
Yeah, I agree.
All right, another question that was submitted before today's presentation. How would you assess the future of higher educational institutions in the Western New York region after the pandemic?
Well, again, I think the situation that this pandemic has put us into made us all learn how to teach online. So I think online education will be more important, will definitely not replace face-to-face, but will be more prevalent than it had been previously. It will also sort of translate to areas in which certain colleges do their business better than others, which will probably lead to some of the local private institutions to close.
Yeah, and the stress, go ahead, Mark.
The demographics, have been, in terms of, let's say, the number of high school graduates and so on, have been declining. And so, in this area where, they've been increasing, where the population has been increasing, which is essentially in the South and the West of the United States. So, the prospects are probably not good, and we're likely to see, as Juliana pointed out, some exit from the education industry.
I believe that the stress on the state budget is not going to go away. This is not an interruption, and everybody's going to double their tax payments over what they would have paid in the third and the fourth quarter. So state budgets are under stress. The fiscal stimulus or rescue plans have so far excluded state governments. The general fund balances of state governments have fallen. All of that leads me to believe there'll be less willingness or ability to support the SUNY system in New York State. That doesn't mean it's going to disappear, clearly, but they're going to face some budgetary issues that they have not in the recent past.
We have a participant asking to know your thoughts on a recurring stimulus payment or universal basic income and how it could be adjusted for each area's cost of living. For example, it doesn't seem fair to New York City residents that they would get the same as Buffalo residents when it is much more expensive to live in New York City.
Yeah, the effect on the federal deficit and on the national debt has been huge already. And these, kinds of payments can't continue to go on forever. I just don't see that as a possibility without other harmful consequences to the economy.
I believe the federal stimulus and then the Federal Reserve's actions to diminish the negative effects of the massive deficits was appropriate at the time. It was adequate to some degree. Could it have been better? Yeah. Could it have been worse? Absolutely. But it can't go on. It can't be always there. There is no capacity. Mark pointed out that from last month, there was a decline in the CPI, but year over year was a slight increase in the CPI. If we simply print money, which is what the Fed does when it buys treasury bonds or any bonds, there will be a risk of long-term inflation. So no, I don't see this continuing either.
We've had a couple questions come through about the Western New York housing market. There's one that just came through. The Western New York housing market traditionally has held up better in past recessions, especially the Great Recession. Since the local housing market had unusually large price gains in recent years by local standards, is there concern that the hit to the local housing values also could be greater this time around?
Dr. Gowieski is into the market. Let her start.
Yes, I think that the local housing market will be negatively affected as consumers are very wary about their economic prospects. It's unlikely that they are going to be purchasing houses anytime soon, and the supply is quite high. Dr. Palumbo picks on me because I have Zillow updates all the time. I recently bought my house, so I get updates all the time about how many houses are being put on the market, and right now supply is a lot higher than anticipated demand.
The questioner was correct in saying that in the last recession we were less than the nation as a whole, because for the previous decade we grew at about 60% of the national rate. So we don't have quite the same cushion this time, but still, not everyone who is relocating will be working from home. And we may see an influx into areas like Buffalo and Rochester and Syracuse from other places, though dramatic declines in their housing prices might slow that process down. I have no idea exactly how things will change in the near future.
Another question that was submitted prior to today's session is attendee would like to know what your view on the recent federal stimulus packages are that have been criticized for their lack of regulations and confusing repayment instructions.
Yeah, that CARES Act was passed very, very quickly, and we needed something fast. And whenever you do something fast, there's going to be mistakes made, and I'm sure there's plenty of mistakes. With seeing who's getting the funds and double payments and so on, you see these things in the news all the time. But you know, we needed something dramatic to happen, and Congress did act on it with, you know, trying to get some money into the economy. So I think in hindsight, it's always easy to point out the mistakes.
I agree.
Another one that just came through. Collection or the inability to collect taxes has a huge ripple effect on many businesses. Many construction projects hinge on state, local, and even federal tax support. Would you see that the public K-12 schools, colleges, and many other projects will be stalled due to lack of funding? Architects, engineers, and many others also would rely on this too.
I think there's no doubt that there'll be some dislocation into the future. As I said, answering one of the earlier questions, the state has lost that revenue. It unlike the federal government, does not have the capacity to create new money to make up for that gap, and there will be less. There will be a secondary and tertiary effects of this economic dislocation. Again, I hate to try to predict how much, but I can't see how it could not be that way. We've lost 3 months, and we don't know how long it will take before we regain the revenues that states have to collect and governments have to collect to pay for those projects. At least a delay, and maybe just a cancellation of some things that were scheduled.
Another one submitted prior to today. Do you think the impact of COVID-19 will have long-term negative implications for the economy, or are things returning to normal within the next 6 to 10 months?
6 to 10 months. I don't think things are going to turn around that quickly. You know, over the long term, look, the U.S. economy has been resilient. It's recovered from many difficult economic periods, and I'm sure that it's going to rebound again. But that's really over the longer term, which I think is, you know, like I said, I think we're likely to see the economy contract, you know, in the third quarter, at least of 2020, maybe the fourth quarter as well, before, you know, returning to positive growth.
How long did it take, Juliana, for us to regain the jobs we lost from 2009-10? It was 8 million jobs, took how many?
5 years?
5 years, yes.
Yeah. So this is 21 million jobs. I'm not predicting it'll be 2.5 times as long because it took 3 years to lose all those jobs. But I don't know. What do you think, Mark?
Yeah, it's, you know, you see different things. There's an article in the Wall Street Journal today about the recovery being like the Nike logo, the whoosh. It's going to be long, you know, a long stagnant period before it rebounds. On the other hand, you know, consumers have had nowhere to spend their money. I mean, they don't have income, any of them as well. But you've got, you know, that there could be ultimately a, you know, a big explosion in the level of consumption expenditures once things get back to normal. So, you know, as we've gone down very quickly, I don't know. I mean, I don't think it's real likely that we're going to go back up as quickly. But again, over the longer term, I am not as pessimistic, let's say, as I am about the short term.
Mark, that kind of leads.
I believe we got to wait. I think we're going to have to wait to see if there's any secondary effects on the financial markets. Just how many bankruptcies are there going to be? How many defaults are there going to be? Because we could have a second round of decline, and we don't know. I think the Fed's action was appropriate. It was a short-term stopgap, but it's not a long-term answer. So there's a lot more things to be worked out.
Another question that came through that might have been touched on a little bit in that last answer. What shape do you see the recovery in Western New York? V, U, W, and Y?
Some combination of all of them. I'm not really sure. I think it's many would say like a very fast decline and stagnation, and ultimately, I don't know, that really doesn't conform with any letter, I suppose. It's not going to be V-shaped, maybe a prolonged U-shape, we could say.
I agree. Flat for a while and then upward sloping.
Another one just coming through
It's
here.
going to take a long time for everybody to get back.
With our national debt today resting at 20 trillion, as noted by Dr. Palumbo earlier, how does the debt compare on a historical basis with respect to GDP?
It's over 100% now. Today we don't know exactly what the debt is. There was a new issuance today. The Treasury was going to the market with $10 billion today. This 3 trillion doesn't go on all at one time, but approximately 100%. It was higher than that in World War II and lower than that just about every time.
Exactly. Yeah.
Too. Does that answer the question, you think, Mike?
I think so.
Okay.
Another one that came in previous to today. What is the outlook for bad debts due to the pandemic?
I think we're going to see small businesses be harmed more than anybody else. And a lot of that will depend upon how much harm there is, will depend upon the actions of things like the Small Business Administration. As I said before, 2001, 2009, many of our MBA students graduated in the teeth of those post-recessions, and their first jobs were in things like SBA, going to the, stepping in to support small businesses. I think we're going to see a round of support from the federal government into the future. I think that's a bad sector.
Government policy has always been, sort of too big to fail. We're going to bail out institutions which the government thinks are too big to fail. That happened during the last recession, in the banking and insurance industry, and the bailout of General Motors at that time. I mean, now the airlines are being supported. So, I think if you're a small business, you have more to worry about than if you were a huge corporation. There are likely to be more bankruptcies, especially those types of businesses that are operating on very thin margins.
Another one just coming through. How much do you think the unemployment numbers are affected by the number of self-employed and gig workers who have been able to apply for the first time ever?
That's a good question.
Well, some of it is going to have to do with the decision of whether to get a small business loan versus go for unemployment. Because if you are the owner of a really small business, it may make more sense for you to apply for unemployment insurance. So to that extent, they're more likely to be captured by that. The data is available. The CPS data is available. So that's an interesting question that I'm definitely going to look into after this. But on first glance, we don't necessarily know that breakdown.
If nobody has any more questions right now, I'd like to thank our panelists again for their time and expertise today. If you look in the chat and you do have some more questions, there is going to be an additional Zoom meeting that has been set up that will start 5 minutes after the conclusion of today's presentation, where you can have face-to-face one-on-one time with our presenters. Again, I'd like to thank everybody for their attendance, and again, thank our panelists for their expertise in taking time out of their day to share with us.
Thank you very much.
Thank you.
Thanks.